Podcast with Michael Lodge. Listen to all of our podcasts at www.wbtpod.com. Stay informed. Let's get started.
This is brought to you by Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business and tax services.
And welcome to another podcast of the WBT with Michael Lodge. I'm glad that you've joined me. If you hear me stopping, and I've said this several mornings now, and you hear me coughing or wheezing and stuff, it's because I have this really bad pollen that is going throughout exposing this really fine gray powder that lands on your car, and it's all over. I've been working outside over the last several weeks here, and I think it's taking its toll on my breathing and coughing. Excuse me. Also, fair warning here, I have my dogs with me, so if you hear them start barking, they're just being dogs because they think the contractor's outside and knocking on the door, and all they're doing is working. So I'm sorry, but the dogs are just going to be dogs. And as I was listening to how they run their companies and how they manage their companies, I came to the conclusion that most everybody is not looking at their financial statements or the story of their company, but instead the only thing they care about is how much money that they have in the bank on a day-to-day basis, how much money they have to pay their bills, their payroll, their leases, their rents, and whatever is left over they feel good about. Unfortunately, that's not how we manage businesses. The financial statement is a very key aspect of making decisions on the story of your company and the financial condition of your company. If you can read a nutrition label or a basketball score, you can learn to read basic financial statements. Easy peasy. If you can follow a recipe or apply for a loan, you can learn basic accounting. The basics aren't difficult, and they sure are not rocket scientists. So we're going to talk just a little bit about understanding your financial statement and what it's all about. We'll try to keep this brief because I know that you have other things to do. And talking about financial statements probably isn't one thing that you even want to listen to, but you need to. And the reason why you need to is because if you do not know the financial story of your company, you cannot tell it to anybody else. So let's begin looking at what I think we all remember the movie where Cuba Gooding Jr. he had those immortal lines from the movie from Jerry Maguire, "Show me the money." Well, that's what financial statements do. They show you the money. They show you where a company's money came from, where it went, and where it is now. Understand. 3 are very important if you're running a small business, publicly traded company. So the 3 financial statements, they are the balance sheet, the income statement, cash flow statements, and number 4, for you who are running a public traded company, statements of shareholder equity. Balance sheets show all the fixed assets that are on that balance sheet, what you owe. So it shows what the company owns, it shows what it owes at a fixed point in time. Income statements show how much money a company made and spent over a period of time. Cash flow statements show the exchange of money between a company and the outside world, also over a period of time. And then the 4th financial statement, called a statement of shareholders' equity, shows changes in the interests of the company's shareholders over time. And the balance sheet, again, is the story of your company. A balance sheet provides the detailed information about a company's assets, liabilities, and shareholders' equity. So if you take a look at assets, assets are things that a company owns that have value. This typically means they can either be sold or used by the company to make products or provide services that can be sold. Assets include physical property such as plants, trucks, equipment, and inventory. It also includes things that can't be touched but nevertheless exist and have value at the same time. Such as, a good example would be such as trademarks and patents. And cash itself is an asset. So are the investments of a balance sheet, the assets, the liabilities. Now we get to the liabilities. Liabilities are amounts of money that a company owes to others. This can include all kinds of obligations like money borrowed from a bank to launch a new product, rent for use of a building, money owed to, owes to its employees, environmental cleanup costs, or taxes owed to the government. Liabilities also include obligations to provide goods and services to customers in the future. Down at the bottom of the liability side, you will see a section that is called shareholder equity. Shareholder equity is sometimes called capital or net worth. It's the money that would be left if a company sold all of its assets and paid off all of its liabilities. This leftover money belongs to the shareholders or to the owners of the company. A balance sheet is set up like basic accounting equations shown in so many textbooks that you can look at. On the left side of the balance sheet, companies list their assets. On the right side, they list their liabilities and shareholder equity. Sometimes balance sheets show assets at the top, followed by liabilities with shareholder equity at the bottom. Assets are generally listed based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year. A good example is inventory. Most companies expect to sell their inventory for cash with things a company does not expect to convert to cash within 1 year, or that would take longer than 1 year to sell. Non-current assets include fixed assets. Fixed assets are assets used to operate the business, but they are not available for sale, such as trucks, office furniture, computers, and other property. Liabilities are generally listed based on their due dates. Liabilities are said to be either current or long-term. Current liabilities as obligations a company expects to pay off within the year. Long-term liabilities are obligations due probably more than one year away. So we have to look at the balance sheet. What it really basically does, it's a snapshot of a company's assets, liabilities, and shareholders' equity at the end of the reporting period. It does not show the flows into and out of accounts during the period. I want to also talk to you about on the asset side. You have a thing called accounts receivable. Those are things that you have billed for, but you have not collected on. You have a problem. If they're running past 90 days, then you haven't done good accounting management or good financial management. You've let these clients slide without collecting the money. Once you see a company that has a real problem collecting their accounts receivable, they've done the work, they've built up, but they haven't collected the cash, you have a real problem when it goes past 30 days. That means you're acting basically as a bank. Once they go past 90 days, the problem gets even worse because sometimes you can't even collect those amounts. You've just put your company at risk by not making sure that you're collecting your accounts receivable. Because the risk is that some of those companies may go under and you haven't collected your fees. And if they go into bankruptcy, that means you'll get probably nothing, or maybe, if you're lucky, pennies on the dollar. Pay attention to your accounts receivable. Don't just look at what's in the bank. Look at what's sitting out there, receivables that you can collect and you need to collect. Again, if they go past 30 days, you've just put your business at risk. I love the income statement because it's kind of like a scorecard. It's that document that you look at to see exactly how much sales you brought in, and I always list mine out by product line, so I know exactly what products I'm selling on my financial statements, which are the categories that are doing really well, and those items that are doing poorly. So an income statement is really basically a report that shows how much revenue a company earned over a specific line, a specific time period, usually a year. And income statement also shows the costs and expenses associated with earning that revenue. The literal bottom line of the financial statement, of the income statement, usually shows the company's net earnings or losses. So this tells me and you how much the company earned or lost over that period of time that we're looking at. So maybe this would make it simple. To understand how income statements are set up, think of them as a set of stairs. You start at the top of the total amount of sales made during the accounting period. Then you go down one step at a time. At each step, you make a decision for certain costs or other operating expenses associated with your revenue. So then you go down one step at a time, as I said. At each step, you make a deduction for certain costs and other operating expenses associated with earning the revenue. At the bottom of the stairs, after deducting all of the expenses, you learn how much the company actually earned or lost. Most everybody, people call this the bottom line, the net income. Income minus cost of goods minus operating expenses gets you down to the bottom line. At the top of the income statement is the total amount of money brought in from sales of products and services. The top line is often referred to as gross revenue or sales. It's called gross because expenses have not been deducted from it as of yet. So the number is gross or unrefined. No expenses have been taken out. If you hear something outside of my window here, we're drilling holes into the ground so that we can lay cement for posts to go up to a porch that we're building on this house that goes from one end of the house to the other side of the house. It's a southern house, a southern house, and it needs to have a southern porch. So you can go out there and sit in the rocking chair and have a good time. So if you hear that noise, I apologize for it, but we're trying to get some work done. So that kind of tells you what the income statement is really basically all about. How much accounts payable or what you owe people. To a bank or you go to investors, they want to know what's on that balance sheet because that traded your company. So just because you think you have enough money in a professional way, because you're not reading your financial statements. The third part is the cash flow statements. Now, the cash flow statements report a company's inflows and outflows of cash. This is important because a company needs to have enough cash on hand to pay its expenses and purchase assets. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generated any cash. Cash flow statement shows changes over time rather than absolute dollar amounts at a point in time. It uses and reorders the information from a company's balance sheet and income statement, income or decrease in cash for the period. Generally, the cash flow statements are divided into three main parts. Each part reviews the cash flow from one of the three types of activities. 1, operating activities. 2, investing activities. And 3, financing activities. So this shows the in and the outs of cash going out of your company. It's very, very important that you understand that. Now, I'm not going to go over the equity side because that I will do of what the shareholder equity and how it's calculated. A lot of you don't know even anything about that part of your business. But that's really for publicly traded companies. So that's going to be a very short podcast because most of us that I'm talking to are individuals operating small businesses or startups. So I hope this helps you just a little bit more to understand how to read and understand the financial statement. I'm telling you, just because you have enough cash in the bank doesn't mean that you're operating your company very well. If you're not looking at your month by month income statement and seeing how you're operating and see what your highest costs are there any ways to lower those costs? Is there any way to increase revenue? What product lines are not selling very well? It's not just about all the cash in the bank. Just because you're meeting your obligations doesn't mean that you're playing it smart and operating your company better to increase your revenues, to increase that bottom line. If you have any questions, just send me an email at mlodge@lodge-co.com. I'll be more than happy to go over it with you. If you want to send me your financial statement to give it a quick review so that you can understand it, I'll be more than happy to do that. We do this for companies all. This is Mike Lodge for the WBT. I will talk with you very, very soon.
Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business.
The WBT with Michael Lodge. Join us again tomorrow as we explore more about business and taxes. Follow us on iHeartRadio and go to our podcast website at www.w